Welcome everyone to our next PCM webinar. This webinar is going to focus on current market volatility. I'm joined today by Andrew Randisi and Chris Mallon. They are both senior financial advisors here at PCM. Our topic of market volatility. Chris, do you want to bring up the slides? We'll get started with the slides. And we've titled this webinar, Riding the Wave. And what we're here to do today is to help you ride the wave. And we know these waves can be, frankly, nauseating sometimes. So hopefully we'll help you ride the wave. And I'll hand it over to you, Chris.
All righty. So right now we're all experiencing quite a bit of market volatility. We entered yesterday a bear market, the S&P 500, which is when the market is in a 20% drawdown in any given year. These are healthy parts of the investment cycle. They don't feel great. However, they are normal and occur pretty regularly. History has shown that stock market declines are a natural part of investing. They are temporary and do not last forever. Knock on wood, the US stock market has recovered from every drawdown it's experienced thus far. Declines have varied in intensity and frequency, and they have been somewhat regular events. Andrew will go on the next slide, some historical details, how regular they occur. And then a quote from Warren Buffett: "The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people." A lot of recurring themes we'll touch on here is going to be time horizon, more about time in the market than timing the market. Another reason why this feels extra painful is the fact that us as humans tend to extrapolate things further and further. We tend to think, oh, this will continue on, and then things change. It's something that shows in the market every day. I'll go to Andrew here. I'll talk about some historical drawdowns and their frequency of occurring.
Okay, thank you, Chris. So we wanted to give our viewers out there a quick history of market declines. So the index that we chose would be the Standard & Poor's 500, also known affectionately as the S&P 500. This is the 500 largest stocks in the U.S., or as what we mainly the barometer for how the U.S. stock market is doing. So there's all different sizes of declines. The most that most of us do not really feel would be a 5% decline. It can happen about 3 times per year. It can happen very, very quickly. The average length is a little more than maybe 43 days. So 6 weeks tops. The last time we saw one of those was in early October of 2021, before we saw the volatility in the beginning of the year. These are the kind of statements of declines that really don't ruffle too many feathers, because you might not even notice this on your statement, especially if you get quarterly statements. The next decline, which is 10% or more, we call it a market correction. That's what Steve Palmer at PCM likes to call it. This happens about once a year. It can average around 110 days, so a little bit more than 3 months. And again, depending upon how the happens during the course of the year, again, you might, a client, or as you, the average investor out there, might not notice this in your statements, especially if it happens in between quarters. Last time this occurred was September of 2020, when the tech stocks took a little bit of went down 10% or more and brought down the S&P. The next 2 levels is when you start to hear about it, not on just the stock market channel, but you start to hear about it on the evening news with David Muir. And that would be a 15% or more stock market correction. This can happen once about every 3 years or so. It typically lasts about 250 days, so almost about a little bit more than 8 months or so. This is where you'd start to feel a little bit worried. And then the last one, which Chris mentioned, which we're in right now, is a bear market, which is a 20% or more decline. This is when not only it hits David Muir, it also hits on your local news when they have really nothing to talk about, so they talk about the stock market. So when you see it on all different news outlets, that's when things start to seem scary. But as we'll get through in the later slides, it happens once every 6 years. The average length can be a little bit over a year, or that we have a bear market. But as we'll go in some later slides, there are some ways to kind of subside the tides and ride the wave.
Yeah, I think an important takeaway from this is how frequently that these declines occur, especially the 5, 10, and even 15, about once every 3 years. That's pretty common. Over an investing lifetime, you'll experience 15% drawdowns. What if you're working 30, 40 years? I mean 10, 12 times, 20% or more, you're going to experience that, between 5 and 10, again, depending how long you work. So they happen pretty regularly. And then we tend to have short memories and kind of forget about it, which this next slide talks about a little bit. It's important to keep a long-term perspective about investing. Studies have shown that people place too much emphasis on recent events and disregard long-term realities. Even amid market downturns, stocks have rewarded investors over time. And including all the downturns we've experienced historically, the S&P's average return over all 10-year periods from 1937 to December 2021 was 10.5%. You can look at that on this chart here. So what we're looking at here is if you invested on August 31st, 2029 to August 31st, 2039, the average during that time period was 5.3%. If you're looking at investing at that same date, so 8/31, bear with me, 8/31 on any of these given time periods, these are your 10-year rolling returns. Not too bad, right? So again, the longer you look, things look better. The short term can be very, very painful when you experience those drawdowns because markets fall faster than they rise. It's really about staying in the market through long term, not getting too nervous and pulling out when you see these spikes in volatility.
As Chris just said, don't try to time the market. It's more about your time in the market. Research has shown that losses feel twice as bad as the gains feel good. Selling out of the market to reduce losses could mean missing out on gains when stocks recover. We often have this conversation with clients that say, Andrew, should we just sell everything and buy it back later? And what I often usually say as a response is, I wish we knew when the time was to sell and then when the time was to get back in, because it's trying to answer two questions. When's the good time to sell? Could stocks continue to go back down? Could they go back up? Most of the time, you're going to be wrong either on when you sold out or when you got back in. That's why it's best to have an asset, have a diversified portfolio that fits your long-term goals and be able to ride the wave. Every S&P 500 downturn of about 15% or more since 1930 has been followed by a pretty noticeable recovery. And Chris will pan to the next slide. Okay, so this is a chart showing the 5 biggest market declines in subsequent 5-year periods. So we have 5 points in time here. The first one would be the stock market crash of 1929 and the beginning of the Great Depression.
Yeah.
The next period would be continuing on with New Deal programs, more of the Great Depression, and then the beginning and start of World War II. In the 70s, this is kind of very similar to what we're seeing right now. There was an oil embargo in the early 70s, leading to very, very high gasoline prices. And you had stagflation, which would be very, very high inflation with slowing economic growth. The market decline during that close to 2-year period of time was close to 50%. In the early 2000s, when Chris and I were in kindergarten and first grade, you had the dot-com bubble crash. That was the NASDAQ, which would be all the technology stocks. Everything that had a .com next to it was really pumped up in value, and then there were no earnings. So the companies naturally everything came back down, and a lot of those companies just went belly up. And then as most investors now remember, the GFC, the Great Financial Crisis, that happened in 2007 through about 2009, with the market again pretty much chopping itself in half. What's noticeable with all 5 of these periods of time, when it really felt like in all 5 different periods, the sky was falling, the stock market had recovered. And 5 years later, you had a pretty nice result with a 5-year average annual return of close to 36% following 1932, close to 20% following 1942, 17% following 1974, 17% again following 2002, and then 25% the first 5 years following 2009, which it kind of gives us an average of about 23% following a large market decline when the market cuts itself essentially in half. The real takeaway we'd like to take away here for you viewers out home is the market does recover after a bear market decline, and the recovery can be quite strong.
Yeah, well said. Yeah, and that's another kind of going back to timing the market. One of the things that can feel good in the short term to, sell everything and see your account balance kind of stabilize. But then what are you have to have a game plan to get back in. If you do that right, you can't just sell and then wait until things quote unquote stabilize and get better. When would that be? Or do you feel like, is it after that first year? And you can look right here, the first year back after a recovery is, this is where your significant gains are really occurring, right? Is that kind of that quick rally back? You really can't afford to miss those. So it's important, again, as we've been saying, stay invested. Trying to time the market is is very, very difficult, if not impossible to do, especially over the long run.
Yeah, Chris, can you go back to that slide for 1 second? I just, piggybacking on what you said there, that first year of recovery is really striking.
Mm-hmm.
The 137 to 64, 44, 36, and 72. That's you're right. That's a number that you do not want to miss out on.
Right, exactly. Because even because a lot of what happens too in the market is a leading indicator for the economy. So even right now, economically, things aren't too bad. The market's doing quite poorly because the market's kind of predicting, a high chance of a recession, interest rates continuing to rise, the Fed kind of being behind the ball there. However, the markets have historically bottomed before the economic news has. So the market will start to, tear upward, and bad news will keep coming out. Eventually the bad news will, hurt way less and really won't have an impact on the market because the market is looking ahead while economic indicators are all backwards looking. So it's important to kind of keep that in perspective as well. You'll see, terrible GDP numbers, unemployment numbers, rising. And the market will, rise on the news. Sometimes bad news is good news, and sometimes good news is bad news when it comes to the markets.
So what if, what if I'm an investor and I'm uncomfortable. I'm a little freaked by, what's going on, and I call you guys up and say, guys, I'm really scared. What do I do? What would you suggest?
Yeah, Andrew, you want to take this first, and then
I would say the first thing you want to check is what is ultimately where you are in your stage in life. If you are already a retiree on a fixed income, you want to make sure that you have a sufficient cash cushion, whether that be an emergency fund of maybe a year or even 2 years of your fixed expenses. That way, if you have to draw on your portfolio, you can kind of still have a chunk of savings to be able to draw off of instead, to wait for the market to recover, because the market will eventually recover. If you are a soon to be retiree, that's when it starts to look about your asset allocation, and is my portfolio rightly aligned to my goals? Am I too aggressive in the markets right now? That's something you'll definitely want to look at. If you are in your early work careers of your working time, and you're in your, I'd say, 20s, early 30s, this is actually a fantastic time to invest. You are buying the market at its cheapest. Could be an opportunity to increase your savings rate if you have an opportunity to do that based on your cash flow, and just enjoy. Think of all of the way I would look at it is you're going to a discount store and buying the U.S. economy on sale.
Yeah. And then one other thing, like you said, Leslie, clients will ask us that pretty regularly. One thing you can do is if you kind of have to scratch the itch, you can make some just rotations in your account. If you have a taxable account, you can take some tax losses. If you bought some growth companies last year and now you're looking at a 20 to 30% loss in a few of those names, you can, very comfortably sell those, take the tax loss and move those proceeds into a similar investment, maybe an ETF that's in the same sector, something like that, to keep the exposure the same. So if these, rallies and run-ups we're looking at do happen, you'll still be able to participate. And then kind of same thing inside of a retirement account, you won't be able to take the tax loss, but if you have to, scratch the itch, if anything, make some rotations, keep the overall allocation the same. So then you can, ride the wave back up instead of, pulling out all the fuel that you would need to get back to where you were. That's usually when people can really, kind of hurt their long-term financial goals. And again, like Andrew said, it's really when clients come to us, we try to turn it around instead of saying like, okay, let's just not look at the current market performance right now. Let's look at what your long-term goals are and kind of reorient what their thinking is in that particular case. And that tends to help keep things in perspective.
Yeah, that makes sense. I read one, piece of advice in an article saying, just remember why you're an investor. You're not, if you're a client of PCM, you're not a day trader. There's a reason why you're investing, and it's long-term investing. And so just remind yourself of why you're putting your money to work.
Right.
That makes sense. And I found one other quote too that I thought you guys would agree with. It says, you don't need to be a math whiz to make good money decisions. Financial success is 5% intelligence and 95% discipline.
Mm-hmm. Yeah. No, it's way more, financial success, I think, is way more correlated with behavior versus intelligence. There are countless stories of, people with high flying jobs have made crazy predictions in the markets, have made a ton of money, and then have made other predictions that have gone south on them and lost it all, versus those who kind of, just behave well and don't try to be a hero, we often say, and things tend to work out.
Makes sense.
Our last slide here.
All right. So to just kind of summarize the points, look beyond the headlines. Don't spend all day staring at the financial news. It's not going to help. Don't forget history, which both Chris and Andrew referenced pretty clearly on those slides. This is very typical historical behavior of the stock market. Maintain a diversified portfolio. Don't try to time the market. Invest regularly, even when the market is falling, and keep in touch with your financial advisor, which is Pennsylvania Capital Management. We're happy to help. We're available to talk if you're stressed about the market, if you're feeling opportunistic about the market, if you're feeling neither of those. We are always here to answer questions and discuss with you. And if you are not a PCM client, feel free to give us a call as well. We're happy to make new friends, meet new people, and I can attest that Chris and Andrew love to talk about the stock market. So they're available to chat with you.
Yeah, please like and subscribe, or look us up on www.pcmadvisors.com.
Thanks, everybody. Take care.
Thanks,
we'll
guys.
see you on the next webinar.
Bye.